from the macro side, everything is basically on track. We had a very strong first half, GDP growth of 8.2%, and on track to deliver 10 to 11% GDP growth for the year, and pretty much in line with the government's target to achieve GDP per capita of 8,500 by 2030, which literally translates to GDP growth of at least 10% every year from now till then. Looking deeper into most of the pillars and drivers of growth, we're seeing everything is as per our expectation, if not even better. For example, total investment for the first half is up 15%, exports of goods 21%, consumption nominal 13%. Elsewhere, in terms of policies, they remain supportive. Credit growth is at 7.14% for the first quarter. Inflation, a very hot topic for this half, is currently at 4.4% as well. In detail, for each of the components, investment, we are seeing 15% up this year. So for the first half, Vietnam's public investment has disbursed 13 billion. And this is also because our fiscal budget is also very strong with intense aggressive, if I may, tax collection, bringing what was initially from the informal economy into registered numbers. So right now we have 17 billion in terms of budget surplus for spending on public investment. If you were to go into Vietnam now, you will see construction basically everywhere. Next year, we are holding the APEC conference in Phu Quoc, and all the infrastructure there is already in place. Elsewhere in Hanoi and Ho Chi Minh City, you see lots of infrastructure constructions going on as well. Ho Chi Minh City with regards to the Ring Road 3, which will ultimately connect a lot of industrial parks from the nearby provinces to a deep seaport. Hanoi, we're also seeing lots of things going on there as well. Another pillar that we consistently emphasize over the past couple of years is our export machine. We are seeing FDI at a record high this year in terms of registration. So we have more than 30 billion FDI registered this year. This is up 61%. And also disbursement is also very strong and healthy at 11%. PMI expansion for the past 12 months has been in positive territory, as you can see on the charts. So what does that mean for our export machine? 1H number is coming in very strong, 21% growth to 266 billion. Much stronger than previous years, as you can see on the chart. And what does that compose of? The strongest that we see are within computers, electronic goods, and also toys, as you can see on the table on the right-hand side. Our traditional export goods in textiles and garments, footwear, and other things, wooden furniture, is also progressing along quite okay as well in that front. Consumption, Zui will provide a much more deeper insights for consumption later on, but headline numbers are pointing to retail and services very strong, stronger since 2019, growing at almost 13%. Netting out the price impact, consumption of goods is also quite stable at about 7%. Services is extremely stronger than goods this half, because tourism is also quite active in Vietnam. We are seeing tourists coming in 15% growth in terms of people, and clocking at about 12 to 13 million tourists for the first half already. With that, we see accommodation numbers, we see travel numbers also ticking up within that sphere. Inflation, very hot topic for this half. So basically, in a nutshell, inflation is back within the 5% ceiling that the SBV has a very sharp eye on. We did see a spike coming on when the Middle East conflict happened, but things have been trailing down lately. As you can see, with June was the first month of decline, month on month, in our CPI. Why this is happening in Vietnam, and Vietnam has been able to contain inflation and manage inflation quite well over the past couple of years, despite numerous shocks whenever it happens, is one, we are quite self-sufficient in terms of food, in terms of our power generation, our energy supply sources. And in addition to that, we also have several funds, emergency funds that we can tap into. For instance, we do have an energy emergency fund that is taxed on petrol products over the past couple of years that we can actually use during times like this half. A quick update on macro happenings in Vietnam for the first half. So those familiar with Vietnam will know about Resolution 68, which empowers the private sector to be the most important driver of the economy, or the public sector. Resolution 79, which came out earlier this year, basically setting the role of state-owned enterprises being the solid foundations for growth. What we recently saw is also Resolution 10, which is more of a guidance on FDI. This was issued in May 2006, and it lists out core industries that Vietnam is trying to attract in recent years, in coming years. Vietnam is targeting quality over quantity. But that said, we are aiming to attract FDI of 200 to 300 billion across a wide range of high-tech industries over the years as well. In a nutshell, so on track to deliver GDP growth of 9 to 10% for this year. Exports good, CPI well managed, currency also very well managed, and if not one of the most stable within the region. FDI and the export story going very strong, investment also quite strong as well. That said, the stock market is doing, if I may say, terrible this year. So we have GDP growth of about 9%, pretty on track to deliver that. And a lot of that growth will be captured in the market. We are aiming for EPS growth, forecasting EPS growth of 23-24% this year. But as you can see on the table, valuation multiples in terms of PE and PB are quite lower than the usual. PE only about less than 12 times, price to book 1.8 times. ROE is consistent around 16-17%. So why is this the case? Although we see earnings robust across all sectors, forecasting 24% for this year, and the only sector we're seeing a decline is in industrials, and that is basically airlines, because they themselves have to import jet fuel, which shut up, and Vietnam does not make jet fuel. Other than that, if you look across all the sectors, they deliver very strong growth overall. Banking 16%, real estate huge jump, consumers consistently strong. As you can see, the market themselves, however, is basically flat, if not going down. So as you can see on the chart on the left-hand side, market has been so-called up 5.4% for the first half. But Vingroup themselves are up 29%, and then Vinhomes 27%. So if you were to eliminate those two, the market is basically flat, or most of the stocks are actually under what it started at the beginning of the year. The blue line there is the banking sector. So banking is basically flat, which means that if you check out Vinhomes, Vingroup, the banking sector, all the other super growing stocks are just like under at the moment. From our observation, why this is the case, I would say that maybe it is attributable to weak local investor confidence. So we had a big dip at the beginning of the year due to the Iran conflict coming down 17%. And every time that happens, investors kind of become a bit shaky, and they kind of need some time to recover from that. Or they need the next leg of catalyst for them to feel their confidence. Q1 numbers, super good, as you can see from the chart previously, but people are somewhat skeptical about Q2, especially with headline inflation and all of those concerns. So that is perhaps one of the reasons why they are tending to wait for the numbers to come out, wait for things to see if whatever they're worried about is really happening, or if that's not the case, before they enter again. And within that context, valuation now is very good. At the moment, if you take into our historical charts in terms of price to earnings and price to book, as you can see from the chart above. So trailing PE right now is about 14 times, which places forward PE at around 12 times. And if you were to take out Vingroup, that means the price earnings for most of the companies in the market on average would come down to actually 9 to 10 times, which is a big value proposition at the moment. So we ourselves are quite competitive versus peers. We usually have this chart, Vietnam EPS earnings growing very strong, the high teens or more than 20% like this year, while valuation is always if not under 14 times. So that has been the kind of dealing that we have experienced in the past couple of years. And we are also hoping that with the potential upgrade in FTSE, with the first tranche of 10% coming in September, this will elevate Vietnam to a new level of other emerging markets, whereby most are trading at PE of shy of 20 times. So in a nutshell, macro strong, on track to deliver 9 to 10%. All of our key pillars indicators are intact. However, the market themselves, there's a big discrepancy between fundamentals and earnings and stock performance. So market earnings are projected to be around 23-24%, while valuation right now is at a very good level of around 11 times. So this would be actually, not to sound like too positive here, but it will actually be a good time to actually come in. What we have observed over the years is a decline in foreign ownership. So in 2023, foreign ownership was around 19%. Right now, it's only at 12%. So at the moment, over the past couple of years, AI is a hot trend. Money's moving there. And the market has been up primarily because of locals. Whereas right now, locals themselves are weak, the foreigners are not there. So if everything comes back altogether, then we're bound for an increase.